why we think India right now is ready for this kind of an approach.
India, what has happened in the last 10 to 15 years is that the depth of the market has increased.
How would you explain what you do to a person on the street, let's say here in India?
So let's talk Formula One, Ferrari. For a second, as these cars become more sophisticated, there's more electronics involved, actually the role of the driver, if anything, becomes more important.
Your favorite signal?
Online job posting, tens of millions of job postings to identify companies that will perform better than their peers.
Thousands of data points on so many stocks. How does a human being process all of that to make a decision? Hi everyone. I'm Swaminathan, MD and CEO of BlackRock AMC. Welcome to the podcast. Today I have with me two very, very special guests. Firstly, I have Rishi Kohli, who is the CIO for BlackRock AMC. And then I have Raffaele Savi, who's a global head of systematic investing at BlackRock. Welcome to the show, guys. How are you feeling?
Great, thanks.
Fantastic.
Okay, Raffaele says fantastic in a very convincing way. I want to let everyone here know that he is in the midst of an Asia tour. He's flown in this morning from Singapore. He's in Mumbai for 8 hours and he flies to Sydney. So when he says fantastic, I don't quite believe him, but we're going to see how this all goes. Thanks again for being here. This means a lot to us. Let's get started with finding out a bit more about yourselves. And we'll get into the meat of the conversation a bit later. But firstly, I just want to focus on you and what you guys do on a day-to-day basis. So let's start with you, Rishi.
Sure.
CIO for BlackRock AMC. What does that mean? How do you explain what you do on a day-to-day basis to, let's say, your grandparents?
Sure. So explaining about investing in the public markets and in listed stocks, I mean, the way I explain it to parents or grandparents or whoever doesn't really understand finance or markets much is that's similar to how they would put money in the bank and that would grow because of interest, or they would put money in real estate. Everyone buys a house or an office, how that would grow. Similarly, you can buy stocks which grow, which are companies and, things that are relatable to them.
Yeah.
And then, of course, we are doing systematic investing. It's not just investing any other way. And systematic, the way to explain it is relating it to cricket, since everyone in India understands and appreciates that. And think of it like a run out and an umpire there on the field, has a split second to make some decisions and will do it based on limited data or whatever he's seen in those split seconds. But a third umpire would look at all the data that is out there, look at the run out from different angles, different spy cams, other things, and then come to a conclusion. So similarly, we look at all types of data, traditional and alternative, and then decide what stocks will go into the portfolio.
Very interesting. Raf, you're from Italy. Did any of that cricket analogy make any sense to you? Okay, it did. Very good. I'm impressed. Now, I'm also going to take the liberty of guessing that your grandparents probably know everything about systematic investing anyway. So how would you explain what you do to a person on the street, let's say here in India?
Right. I think Rishi did an excellent job at describing what investment is all about, which is you have some money today that you can save and you want to get more out of your saving at some point in the future. Maybe you want to pay for your kids' college, or maybe you need to pay some healthcare, or maybe for retirement. And so you might need that money 5 years from now, 10 years from now, 20 years from now. And of course, whether it's real estate or whether it's a particular stock or a lot of things will happen in this 10 or 20 years. And the idea of building systematic models is to make sure that not only you get the highest possible value of your money back, but also that the journey to get there is as smooth as it can be, irrespective of what happens. And so building models is a way to sort of engineer some safety in this investment problem.
Okay, third umpire decisions, building models. I feel like we're off to a good start here. So let's carry on with that, right? Why are we here today? We are here because we are launching BlackRock AMC's first active equity fund, and we have chosen to go with the systematic approach to investing. Now, this is something that I know from my experience BlackRock has done for many, many years. And in fact, this is the 40th anniversary of systematic investing in BlackRock.
Right.
Raf, you've been around for most of that time. So talk to us a little bit about the history of systematic investing, if you can, how you got into it. And just so that the people get a bit more color on, is this something that has just kicked off now? Is this something that has been going on for a long time? 40 years feels like a long time, but I would love to hear a lot more from you.
Yes, so I've been with the team for 20 years, so exactly half of this period. And I think three comments to your question. So the first one, the style of investing has been moving over time from something for large institutions to something that has become available also to individual clients. So in some sense, the theme that I know it's very dear to your heart and to the mission of Geo BlackRock of democratization of investment approaches is very much behind the trajectory of the years that I've been involved with the business. The second idea is that we've seen these models evolving from a few concepts from academia and universities, that there are some patterns that one can find in data, that in this mix of art and science, there's more science than people thought about investing. And the field has grown a lot from a couple of ideas like value, momentum, or low volatility, to now models that as Rishi was saying, are looking at every factor and every piece of information that you can imagine about companies. Thousands of data points, hundreds of signals that sort of constantly evolve and adapt to different market environments. So if you want, the first topic, the first theme is from institutional to individual. The second trend that I've seen over this sort of decades has been from small models, a couple of ideas, to larger models. And the third one that I also think is interesting is from a topic by expert for experts. We now live in a world where, whether you want to call it AI, whether you want to call it machine learning, we are all using it to interact in, we interact with this algorithm in so many things, whether it's search, whether it's a mobile app. Geo BlackRock is very much a digital first. And so, I like to think about systematic also as a digital first way of managing money.
Yeah, the second point you made is an interesting one, right? Because you mentioned, thousands of data points on so many stocks. How does a human being process all of that to make a decision? I know Rishi's a smart guy, but that sounds like a lot. So how do humans get involved in this, or is it all machine?
I actually think it's interesting to me if you think about Rishi was mentioning cricket, very Indian thing. I'm Italian, so let's talk Formula One, Ferrari for a second. As these cars become more sophisticated, there's more electronics involved. Actually, the role of the driver, if anything, becomes more important. And I think that's sort of also a little bit what's happening here, which is as your instrumentation becomes better, your analytics become better, you can ask more questions, you can build portfolios that are more resilient, and the human hand is very important in this process. And so in some sense, you end up, maybe you have more the role of a pilot and a designer and an engineer, that's sort of the person looking at every stock every day and making every decision, but you leverage the strength of this larger model and you guide them in whatever is the most appropriate way for that particular market.
That's interesting. So in terms of the market itself, right, are you, in your experience, seeing it work better in some markets, this kind of strategy, or not as good in other markets? What are the conditions that need to be met for this to work?
Yes, I think one way I used to think about it, and I think is still valid, is that if you have liquid assets, if you have the ability to to trade in and out of a particular asset. And if you're looking at sort of a reasonable time horizon to do so you can't change your positions, these models tend to work very well. And so equities is a great place to start because you have a lot of liquidity, you can trade, you can update your views, and your holding period can be short enough. These models perform really well. So if you have liquidity and breadth, it's a way to start. So would I use these models to pick one stock that I'm never going to be able to touch for the next 20 years? No, that's not the way to go. But if you're building a portfolio that has dozens or hundreds of stocks and you can reasonably trade in and out, these models actually tend to perform pretty well in pretty much every market in which we implemented them.
Okay, Rishi, over to you. So we've heard all of this. Does this apply to India? I'm going to assume that given that we're launching a fund, you believe it does. So explain to me why we think India right now is ready for this kind of an approach.
Yes, so I'm just taking on from what Raffaele just said, that India, what has happened in the last 10 to 15 years is that the depth of the market has increased. So you have a lot more stocks listed, and that is a clear trend going forward too. A lot more IPOs happening, a lot more stocks coming in. So the depth of the market is increased, and then the liquidity is increased as well compared to 10, 15 years back. And along with that, the data, the quality of the data as well as the volume of the data, all of that has also really increased. So all of these are exactly as Raffaele was saying, very conducive to a systematic approach. And because all these developments have happened in India over the last 10 to 15 years, this is a perfect time to start a fund based on the systematic approach.
And when you say conducive, I mean, yes, that makes sense from what you guys have said on how the approach works, but for the customer, so let's put ourselves in the shoes of the customer. So what does this kind of an approach actually give to the end investor?
Yes, so for example, in our approach, we end up coming out with quite a diversified portfolio. And secondly, liquidity, meaning transaction costs can be lower, and that is an important part of our process.
Okay, I'm going to flip back. So there's definitely some value there that we're seeing for the customer, which feels very differentiated. Raf, you mentioned earlier that through the history of systematic investing globally, you saw a transition from more institutional heavy investors to retail. Like, what do you think brought about that? Now we are here going into a market that is more retail heavy. What do you think are the factors that would have maybe facilitated that transition from institutional to retail in other markets?
Right. I think consistency is being the key element that has driven the diffusion of these strategies. There's a lot of good managers out there, but I do think that sort of a challenge, especially for individual investors, is when you have managers that add value, add alpha in a way that is very episodic. It's easy to miss. It's easy to sort of give up when there's a lot of volatility in performance. People can lose sort of the desire to stay invested, and so the end experience of the individual investor in more volatile products has not always been as good.
Right.
And I think what people appreciate of a systematic approach is this sort of risk control, smoother journey. You might not have the standout binary year, but you're also never going to have a year where underperformance versus your target is so big that makes you lose confidence. And so over time, this consistent alpha is not only something that materializes, but it's also something that the individual investor really benefit from because they do stay invested for the journey. So the key word has been consistency.
Yeah, that's interesting. And this consistency, has it worked globally in many different types of strategies, or is it any specific style within the systematic space, whether it is picking stocks or making calls on sectors? My question, I guess, is it robust to cover many different styles of investing, or is it more, let's say, favorable to a particular style?
I'd say that sort of over time has been actually the experience very similar across different markets. You might have a particular market, maybe there's a period of 3 years where international does better than US, or where emerging markets do better than developed market, but over time, by and large, there seem to be some regularities. So one is that the more stock-specific risk, the more consistent performance is. That sort of, you can use, for example, bet on sectors or on styles, but you're better off keeping them reasonably contained in your overall, because that performance tends to be more episodic, and so in moderation is good. But the bulk of the risk you want to take, if you're going after consistent returns, is stock-specific risk. When you're diversifying your views across many, many names, and you don't make any single decision to be the driver of most of your performance. And that's been true in developed market, in emerging market. It's been true across the decades. And so we think that's a good principle to build portfolios around.
And Rishi, is that how you're thinking about the fund that's coming out right now in terms of the Flexi Cap strategy? Is it, as Raf said, more tailored towards stock-specific risk, so making calls on stocks? How are you ensuring that? How is the team making sure that that is exactly capturing kind of the essence of what Raffaele is talking about?
Yes, that is exactly what we are doing in this fund too. And the way it's being done is that in the optimization engine, where the portfolio is getting spun out after the alpha, risk and cost scores go in, what it is doing is that it is neutralizing the factor or the style exposures relative to the benchmark. So which is why you cannot have very active bets relative to the benchmark based on styles or factors. It is very, very negligible. And even for the sectors, there are constraints. So within a certain band, you would say, what we call bounds, but for the local audience, constraints around the weightages. Let's say you would say, just as an example, that for a particular sector A, you would let it vary between plus minus 3% compared to the benchmark. Within that plus minus 3%, the fund managers do have some ability, more from a risk management perspective, to tighten or loosen the bounds. But that is it. It's not like plus minus 10%, which would again give it a lot more sector exposure, sector bets. Another way to look at it is that if you break down the attribution of alpha over a longer period of time, then almost 80-85% would be stock specific, 15 to 20 would be sector, and very negligible 1-2% would be on the factors or styles. So clearly a stock driven approach.
Okay, well, that's reassuring that you've seen it work, and that's exactly what is being built here. And I appreciate that's been quite, let's say, dense in terms of the content so far, but let's be honest, that is what investing is. I want to end on a lighter note, but I'm still going to keep it a little geeky and a little fun, right? So let's start with the geeky bit first, because that's who we are. Your favorite signal?
Okay. I like, of the almost 1,000 signals we have in our library, there's a few where we use job postings, online job posting, tens of millions of job postings, to identify companies that will perform better than their peers. And there's, I like it for a few reasons. One is that very few competitors are looking at it. The view is like, well, it's too slow, is sort of not enough, not interesting enough. And we found that it added value over many, many years. So I like it because it's pretty unique to what we do. I like it because it sort of there's some clever tricks around it that you can implement. And the basic idea is, hey, a company that is hiring is doing well. They know how things are going inside the company, and there's no better sign of confidence than hiring. And then the second one that we also like is when we go and try to sort of scrub these job postings, and we try to understand what skills are companies hiring for, what kind of positions, what kind of people, and essentially, you can do this thing where say, well, what is the market hiring today? What kind of skills, and which companies have been hiring those skills a year ago, or 2 years ago, or 3 years ago? Right. Those companies are going to do particularly better. And so, sometimes again, it's It's a simple idea, but if you're after something that turns out to be true and a lot of other people are doing it, you can generate a lot of value.
That's super fascinating. So it's not just about you have a favorite signal, but it's also how you look at it and how you use it. That's amazing. Okay, Rishi, how are you going to beat that?
Difficult, but let me try. So from my side, analyst estimates, analyst sentiment, target price changes, that group, that is very interesting because again, globally, it has been proven to be a very differentiated signal and source of alpha, and even so in India. So that would be one of my favorites. And second, specifically to do with India, the retail flows in India are very important and very different from how it is globally. And secondly, the mutual fund holdings are also disclosed. So that combination of flows is something which is very unique to India and very interesting alpha potential in the long run.
Okay. Interesting, because I asked you both for one signal and each of you gave me two. So you're clearly very passionate about this. You can't pick a favorite. Right, let's go to the fun one. You can pick currently, favorite book, TV show, movie, whatever. Right.
Oh wow, I wasn't expecting this one. So I spend a lot of time on airplanes, as you know, and so I like series. So I don't have to pick this movie and then that movie. You just look at, watch all the episodes. And I really like this sort of Apple TV show called Slow Horses.
Oh,
I thought it was a lot of fun, and I'm eager for the new series that comes out tomorrow.
Very good. Well, you've got a long flight to Sydney tomorrow, so
That's right.
I'm sure you'll be
That's
able
right.
to smash through that entire series in one go. You should probably be sleeping though. Okay, great. Rishi, what about you?
Just finished reading the book, The Man Who Solved the Market. So that would be great and related to what we're discussing in some sense.
Yeah, I'm not sure if you should give him that. Does that qualify as fun or geeky? It sounds like but that sounds very interesting. I haven't read that actually, so maybe I should. Well, thanks guys. Thanks very much.
Thank you, Sid.
This
Thank
was
you.
great. It was educational, definitely, and hopefully a little bit of entertaining too. And I hope everyone watching also enjoyed. Thanks very much for joining.
Mutual fund investments are subject to market risks. Read all scheme-related documents carefully.